Most investors lose money not because they pick bad companies, but because they cannot handle the emotional roller coaster. You watch your stock drop 30% in a week and panic sell at the bottom. Then you watch it recover without you and feel like a fool. The market punishes emotional decisions more than wrong decisions. Individual stock picking sounds exciting until you realize you are competing against algorithms, institutional investors with billion-dollar research teams, and insiders who know more than you ever will. Here at KB Bluetree, we focus on strategies that actually work for regular people with jobs and lives outside of staring at stock charts. The investing world sells you a fantasy that if you just research hard enough, study financial statements deeply enough, and time your trades perfectly enough, you can beat the market. The data tells a different story. Over 90% of active fund managers who do this professionally cannot beat the market consistently over 10 years. If the experts cannot do it, what makes you think you can while working a full-time job? Problem. You start investing with confidence. You read articles, watch videos, analyze companies, and pick stocks that seem like obvious winners. Maybe you buy shares in a tech company everyone is talking about, or a retail stock that looks undervalued. Your picks are up 15 or 20% and you feel like a genius. You start thinking about quitting your job to trade full-time. Then reality hits. One of your stocks reports earnings that miss expectations by 2% and drops 25% in a single day. Another company you invested in gets hit with a lawsuit you never saw coming. A third stock just bleeds slowly for months with no clear explanation. You check your portfolio obsessively. Every notification makes your heart race. You cannot focus at work because you are refreshing stock prices every 30 minutes. Your sleep suffers. Your relationships suffer. Investing has become a second job that pays you in stress. The real problem is concentration risk disguised as opportunity. When you own individual stocks, you are making massive bets on specific companies succeeding. It does not matter how much research you do. You cannot predict supplier issues, management scandals, regulatory changes, or shifts in consumer behavior. One bad quarter can wipe out years of gains. You are not investing. You are gambling with extra steps in a brokerage account. Then comes the emotional trap that destroys portfolios. You're down 40% on a stock you bought 6 months ago. Every rational bone in your body says sell and move on, but you cannot. You tell yourself it will come back. You've already lost too much to sell now, so you hold, and it drops another 30%. Or worse, you panic sell at the bottom, locking in maximum losses. Then you watch helplessly as it recovers over the next year. You make emotional decisions at exactly the wrong times because you have too much mental and financial capital tied up in individual outcomes. The time cost alone should make you reconsider. Researching individual stocks properly takes hours per week minimum. Reading quarterly reports, following industry news, tracking competitor performance, understanding macroeconomic impacts. Even if you do all that work, you still might be wrong. You could spend those same hours building additional income streams, developing career skills, or actually enjoying your life. Instead, you are playing a game designed for professionals while competing as an amateur. Solutions. Exchange-traded funds solve every major problem with individual stock investing. ETFs give you instant diversification across hundreds or thousands of companies with a single purchase. When you buy an ETF tracking the S&P 500, you own pieces of 500 different companies. If 3 of them collapse tomorrow, your portfolio barely notices. You cannot get fired from a job you do not have. An individual company risk cannot destroy your retirement when you own the entire market. The psychological benefits matter more than most people realize. ETF investing is boring, and boring is exactly what your portfolio needs. You are not checking prices every hour because there is nothing to check. Markets go up and down, but your diversified portfolio smooths out the volatility. You stop making emotional decisions because there are no dramatic single stock movements to react to. You set your automatic investments and live your life. This emotional stability is worth more than any potential gains from stock picking. Cost efficiency makes ETFs even more attractive. The average expense ratio for ETFs runs between 0.03 and 0.20% annually. Compare that to the hidden costs of individual stock trading. Every buy and sell creates a taxable event. Frequent trading racks up transaction costs. Emotional decisions cause you to sell winners too early and hold losers too long. These invisible costs compound against you over decades. ETFs minimize all of them through passive management and low turnover. For growth-focused investors, total market ETFs provide maximum exposure with minimum effort. Funds tracking the total U.S. stock market or the S&P 500 give you ownership in the entire American economy. As the economy grows over time, your investment grows with it. No stock picking required, no earnings reports to analyze, no wondering if you backed the right company. You backed all of them, which historically produces 10% average annual returns over long periods. Income investors get even better options through dividend-focused ETFs. Funds like Vanguard High Dividend Yield ETF or Schwab US Dividend Equity ETF own hundreds of dividend-paying companies and distribute income monthly or quarterly. You get diversification plus cash flow without researching individual dividend stocks. The fund managers handle all the work of identifying stable dividend payers and removing companies that cut distributions, collect the checks. If you want to learn how to accelerate your solo business using AI, check out this video. The Augmentation Masterclass. Human plus AI equals career advantage. Now available on Gumroad and PayHip, links in the description box. Sector ETFs let you express market views without concentration risk. If you believe technology will outperform by a technology sector ETF instead of gambling on which tech company wins, if you think healthcare is undervalued by a healthcare ETF that owns the top 50 healthcare companies, you get the sector exposure without the single company risk. This approach captures your investment thesis while protecting you from being wrong about specific companies. The implementation is simple enough to start today. Open a brokerage account if you do not have one already. Most platforms offer commission-free ETF trading now. Pick 2 or 3 core ETFs that match your goals. Total market fund for growth. Dividend ETF for income. Maybe an international fund for global diversification. Set up automatic monthly investments and forget about them. Check your balance quarterly at most. Spend your newly free time on things that actually improve your life instead of obsessing over stock charts. Success story. Nick spent 3 years trying to beat the market through individual stock picking. He read books, took courses, joined investing forums, and spent 10 to 15 hours weekly researching companies. His portfolio held 22 different stocks across various sectors. Some winners, plenty of losers, and constant stress. After 3 years of effort, his returns averaged 6% annually, while the S&P 500 returned 12%. He underperformed the market by half while working a part-time job analyzing companies. The breaking point came when one of his largest positions dropped. 60% in 2 months. After an accounting scandal nobody saw coming, Nick had done his research. The fundamentals looked solid. Management seemed competent. None of it mattered when the news broke. He lost $8,000 in weeks on a single stock. That loss wiped out 2 years of gains from his winning picks. He realized he was working harder to achieve worse results than doing nothing would have produced. Nick switched everything to a simple 3 ETF portfolio. Put 70% into a total market ETF, 20% into an international developed markets ETF, and 10% into a dividend growth ETF. He set up automatic $1,500 monthly investments split across all 3 funds. Then he stopped checking his account except for quarterly rebalancing. His stress dropped immediately. His returns improved to match market averages. Most importantly, he got 15 hours per week back to spend with his family and build a side business. If you are interested in learning how to start a digital business as an entrepreneur, check out this video, The Digital Freedom Blueprint. Scale your solo business to $10,000 a month. Now available on Gumroad and PayHip. Links in the description. Over the next 4 years, Nick's ETF portfolio grew from $45,000 to $187,000 through consistent contributions and market returns. No dramatic wins, no crushing losses, just steady compound growth, his side business, which he built using the time he freed up from stock research, now generates $3,000 monthly in additional income. That extra cash flow funds even larger investment contributions. Nick's total wealth grew faster after he stopped trying to be a stock-picking genius and started being a disciplined ETF investor. Call to action. Look at your current portfolio right now. How many individual stocks do you own? How much time do you spend researching, tracking, and worrying about them? How have your actual returns compared to simply buying an S&P 500 ETF and forgetting about it? Be honest with yourself. If you are underperforming the market while spending hours weekly on research, you are paying a massive opportunity cost for worse results. Make the switch this week. You do not have to sell everything at once, if that feels too drastic. Start by redirecting new investment dollars into ETFs instead of individual stocks. Set up automatic monthly contributions to a core portfolio of 2 or 3 diversified funds. As your individual stock positions reach your target sell points or become long-term capital gains, gradually transition them into ETF holdings. Within 6 to 12 months, you can complete the transition without triggering unnecessary tax consequences. Calculate how much time you currently spend on stock research and portfolio management. Multiply those hours by your hourly wage at work. That is the real cost of individual stock investing beyond your actual returns. Now imagine redirecting that time toward building additional income streams, developing career skills, or improving your health and relationships. The opportunity cost of stock picking extends far beyond portfolio performance. Subscribe to KB Bluetree for more investing strategies that prioritize your time, reduce stress, and actually build wealth. If you want to learn how to use your newly freed time to build digital income streams, check out KB Bluetree Digital and Online Business Strategy. Like this video if you are ready to stop gambling on individual stocks and start investing like the wealthy do. The secret to building real wealth is not picking the right stocks. It is consistently investing in diversified assets while spending your time on things that actually move your life forward. Start today.